Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in to another episode. On this episode, I want to dive into some of the tips and advice that we give our clients when it comes to credit and the importance of credit, whether you're purchasing or you're refinancing, and the role that we can help our clients achieve their financing goals. Let's go inside and talk a little bit more. Credit is important, and I want to talk quickly about some of the things that we see, some of the misconceptions or the misunderstanding when it comes to credit. So credit is one of those things that you either know what your score is, you actually in tune with what's happening, or you're not too familiar with it. And it's very important to actually be in tune with your credit, especially if you're applying for a mortgage, even if you're applying for a credit card, a car loan, any type of credit facility where you're going to be asking to borrow money. It's important to know what's happening. So understanding your credit is very important. Now, the first and foremost, as a consumer, you're able to pull from two of the major reporting agencies in Canada, whether that be Equifax or TransUnion. Those are the two that the banks use in order to qualify you for a mortgage. So understanding what's reporting to those two agencies can help rectify, and if there is anything that you see there that shouldn't be there, it gives you ample time to fix it. A lot of times clients will come to us, we'll do the pre-approval, we'll see things that are there, but depending on when they go out and purchase and they're closing, there might not be enough time to fix some of these things, or we'll have to basically pivot. So taking that time ahead of time to actually go through and understand your credit is going to save you a lot of time and headaches down the road. So when we're talking about pulling the credit, so now you've pulled the credit report, now what are you looking for, right? So you're looking to make sure that maybe you closed an account. Maybe in that account there was a small balance that was outstanding because there was overdraft, for example, and you didn't pay it, but you closed. Maybe that little small nominal amount has actually been sent to collections, for example, right? So paying out those amounts, understanding that maybe you had a lease on a car that you closed out, but it was never actually removed, right? It's still showing payment. Things like that are very important, very common. You want to avoid having any collections, obviously, as important, that's very important, but you don't want to have to go through any consumer proposals or any bankruptcies, because these are also things that can definitely impact your ability to borrow. Now, on the sidebar, there are lenders that will look at certain things like credit proposal as well as bankruptcy, but it's going to come at an elevated cost. So now you're looking at the credit report, you're making sure that everything on there is correct. Now, how do you improve it? What are some of the tips and advice that you can work with? For clients that have thinner credit, and by thin credit I mean maybe one or two trade lines, which are two items like maybe a credit card and a phone bill, you may want to increase that borrowing trade lines, especially if you have time to buy a home. So you might want to look at that. Now, why I say that is because of this. If you have, let's say, one credit card at $1,000 limit, but you make your payments and your score is really high, your FICO score is high. If you missed one payment on that credit card, that's the only item that's actually driving the score, as opposed to someone that maybe has two or three credit cards, a line of credit, a car payment, a loan. That is going to be a more substantial, media robust credit, right? And if he misses one payment, here and there, it's not going to be a big drastic change to the report as well as to the score, because there's more items driving up those scores and those payments. There's more revolving items to trade and for the credit system to pick up on. So I'm just trying to simplify it. I hope that makes a little bit of sense. So one other thing, when you're looking at all these credit facilities, whether you have one credit card or a few credit cards, is the limits at which these credit cards are being held at. So if you're paying off your credit card every month, then you have nothing to worry about. But let's say you're like many Canadians, you're carrying a balance month to month on that credit card, you're paying interest on it. The idea, in order to keep your credit rating and your credit score up, is to make sure that that credit limit doesn't hit capacity or go over capacity. So if you have a $5,000 limit, and let's say you're hovering around $4,900, and then the interest charge comes in and shoots you up over the $5,000 limit, that's not good either. The rule of thumb, and what we usually tell our clients, is if at all possible, try to pay down those credit cards to at least half or 40% if you can, right? That is sort of where we want our clients to be, so that that credit score can rebound relatively quickly. So that is another important aspect. Now, we touched about collections and bankruptcies and stuff like that. These things are obviously derogatory, and we don't want to see them on there, and discharging them is going to be very important. So understanding when those items are going to be discharged, pulling a consumer report if you've gone through one of those two items, and making sure it's fallen off. Now, when you're looking at the credit, it's very important to understand, what the character, the collateral, the capacity, these items which are part of the 5 C's, how the bank's going to look at your credit worthiness. So has the credit been established for X amount of time? How long have you had credit reporting in Canada? How have you maintained your credit? Have you missed any payments, especially mortgage payments? These are things that the lenders are going to pay attention to, because remember, the lender doesn't know you and they're getting a picture of you through your credit report. And that's why having that credit report is laying the best first impression with the lender when you're walking through the door. Now, is it the only part of the mortgage transaction? No. Is it an important part? Absolutely, because it can impact your rate. It can impact your ability to borrow. For example, working with some of the lenders may say, okay, if the credit score is here, we will only lend up to this servicing ratio. So if your credit is higher, they'll either increase that ability to borrow or they'll cut you back. So having a better credit score may not impact the rate too significantly as long as it fits the bank's criteria, but it can cut you back depending on the lender's guidelines. Now, working with a mortgage broker and your mortgage professional, they will help shop around with lenders that will allow us to maximize your ability to purchase if you so wish. So I know there's a lot to unpack on credit, and credit, to address it in a short video would not be doing it justice. In order for us to get a better understanding of your credit, or if you have any questions about your credit and you want to talk to a professional about it, please feel free to reach out to us at InTouch Mortgage Solutions. We're here to help, and we want to help you get the most out of your transaction and provide that service. Also, you can download the link to our app in my bio, so that you can actually download the tools, calculators, understand exactly where you are. And in there, it actually tells you, if you know your score, where to click, and basically will tell you a little bit more about, if you're playing around with the scores, seeing exactly where you fall. So I hope you found this video helpful. If you guys have any questions, as I mentioned, please feel free to reach out to us. Thank you. Have a great Friday and enjoy the weekend.